Good morning, everyone, and welcome to the launch of the report, Is There an Investment Case for Social and Affordable Housing in the UK? Thank you for joining us. The report was researched and written by Property Funds Research under the sponsorship of the Impact Investing Institute, Investment Property Forum, and Homes England. I'm Jamie Broderick, and I'm a board member of the Impact Investing Institute. I've been actively involved in this research project, which is aimed to bring additional data and clarity to the investability of the social and affordable housing sector in the UK for institutional investors, and in particular, pension funds. Many of you are familiar with the social and affordable housing sector and know perfectly well that the supply of social housing has not kept pace with the need and the demand. You'll recognize statistics like the 1.2 million households the government estimates are on social housing waiting lists in England, or even bigger estimates generated by the likes of the NHF. And all of you are aware of the additional strains put on the social housing sector by the need to address cladding and other safety remediation, as well as decarbonization. It seems an appropriate time to examine more closely the role that institutional investors can play in providing the capital that's needed. I'm pleased to be joined by the report's lead author, Nick Colley, formerly of Property Funds Research and now Global Portfolio Strategist at CBRE Investment Management. Nick will present the key findings of the report, after which we'll have a panel discussion on topics raised in the report, and I'll introduce the panelists at that point. Before I pass the mic on to Nick, a few logistical items. This event is being recorded and will be available for you to review afterwards. We'll send you the link in a follow-up email, which will also summarize the key takeaways from today's session. The email will also have a link to the report if you haven't already seen it. I hope to have time for questions, but we have about 150 people attending this morning and only an hour, so we won't get to all of your questions and comments, but please do post your question in the Q&A during the discussion, and if people will upvote the most relevant questions, I hope we can get to at least some of the key points you raise. And now let's hear from Nick Colley, lead author of the report. Over to you, Nick.
Thank you, Jamie. And good morning, and thank you all for joining this morning for what I hope you will find to be an interesting discussion around our research that, as Jamie explained, explores the investment case for social and affordable housing. I wanted to start off today by taking 20 minutes just to highlight the key considerations that we have identified as part of our research in outlining both the potential benefits as well as identifying the risks around investing in this sector. And as with all investments, there are clearly material nuances around these key considerations, and these are explored further and in greater detail in both the report and hopefully in the panel discussion after this brief presentation. So I would encourage you all to take a look at the report just to explore some of these nuances in more detail. So Lizzie, could we move to slide 3, please? Great. So in terms of the scope of our research, we were commissioned to focus primarily on assessing the financial investment case for both debt and equity investment into the sector. And clearly, whilst ESG and impact investment objectives are very important to investors, these are not our primary focus for this research. However, we will clearly be commenting on these issues where these objectives are clearly mutual. I'd also just like to take this opportunity to publicly acknowledge the sponsors as well for their support, as well as the steering committee and other sector stakeholders who have enthusiastically engaged with this project, whilst noting obviously that any views expressed in the report and in this presentation are the author's own. And slide 5, please, Lizzie. Great. I'd like to start today just by setting out and defining the sector in terms of scale, different types of tenures, and the operators in the sector. As you're all aware, as home ownership rates have declined, there has been an increase in the number of households renting from both private and social and affordable housing tenures. The social and affordable rented sectors account for around 17% of the total housing stock in England, with private rented accommodation very similar at around 19%, with owner occupied around 65%. So clearly the sector is not small in scale. As with the wider residential market, there is an evident supply and demand imbalance. The local authority waiting list in England consistently above 1 million households, whilst the sector has been delivering around 50 to 60,000 additional homes per year across both social and affordable housing tenures. Next slide, please, Lizzie. The sector covers a wide range of tenures, and these each have differing characteristics that impact the respective risks around the prospective cash flows. So for social rented accommodation, rents are initially set using a government-defined formula based on house values and salaries in a base year in 1999. These are then uprated by an inflation-related amount to the point of first letting. Rents are typically around 50% of market levels. Subsequently, rental values can then increase annually according to the government-defined rent policy. This is typically an inflation plus a fixed percentage increase, but we have just gone through a period where the government have mandated a 1% decline in rents, and this is a risk that we'll pick up later on. Also, within this tenure, registered providers can provide general needs or supported general needs housing, with the supported general needs being housing that provides other services that support the additional needs that the tenants require. In terms of rent, it is paid by the tenant from a combination of both employment and housing benefit, with the housing benefit payments financed through central government. Within the affordable housing space, both capped and uncapped tenures. For the uncapped tenure, rents are set at up to 80% of market rents at the first letting, and then increase in line with the government rent regime. For the capped tenure, rents are capped at a local housing allowance level. These levels may or may not inflate over time, and so the ability to increase rents can be more limited. Rents in this form of tenure are paid by the tenant via income from employment, but also some housing benefit where the tenant qualifies. And again, registered providers can provide both general needs and supported general needs accommodation. Lastly, for shared ownership or low-cost home ownership tenures, there are two components to cash flows. The first is rent paid by the occupier on a share of their home that has not been purchased. Rents are normally set at around 3% of the share not owned. The second component is revenue from first tranche sales and subsequent staircasing events, where the tenant or homeowner at the time of their choosing can purchase additional equity in their home. Initially, these assets are acquired by the registered provider at below market value. So when a first tranche sale or staircasing event happens, the tenant pays a proportionate amount that's equivalent to the market value of that share, releasing the difference between historic cost and the value and the market value paid by the occupier. And tenants in this tenure pay for rent and staircasing events from employment income, with cash flows in this tenure likely to be higher risk, we think, due to the link to private housing market prices in realising staircasing capital values, and also given the unknown timing of those staircasing subsequent sort of sale events. Next slide, please. Given that the social and affordable housing sector is a regulated activity, operators are statutorily required to be a registered provider and satisfy the criteria set by the regulator of social housing. This means that to allocate to the sector, an investor either needs to provide capital to an existing private registered provider or establish a new for-profit registered provider. Broadly, there are three types of registered providers in England: local authorities, not-for-profit, and for-profit. Collectively, the for-profit and not-for-profit providers can be referred to as private registered providers, denoting the fact that they are not on the public sector's balance sheet. To date, the for-profit registered providers have limited scale in terms of the amount of homes managed compared to the not-for-profit sector, but are expected to become an increasingly significant part of the provision of these types of tenures. Next slide, please. Now, I'd like to move on to looking at the cash flow characteristics that would underpin both prospective debt and equity returns in more detail. Using publicly available data or annual accounts for not-for-profit registered providers, we can see that for the sector, the main source of revenue has been through letting activities, rather than revenue from the disposal of assets such as low-cost home ownership or shared ownership schemes. At the individual entity level, revenue sources can vary depending on the tenure that that provider focuses on, with some more reliant on asset sales and rental income. This means that registered providers are exposed to different levels of risk depending on how exposed they are to the more secure rental income revenue stream versus the potentially more volatile capital receipts. The figure on the right-hand side illustrates the average profit or surplus margin from various tenures. And as you can see, the sector benefits from relatively stable operating margins, particularly for letting activities that have been consistently around 30%. I'll now move to explore why this might be the case. Next slide, please. Using the publicly available rental data collected from not-for-profit providers, we can analyse the time series of rental values for the sector from 1998 through to 2020. The first table looks at the sensitivity of rents to annual changes in GDP and inflation, as measured by CPI. This analysis indicates that the sector's rental growth has no relationship to changes in GDP with a beta of 0. In contrast, the analysis indicated a significant positive sensitivity or relationship to GDP of 2.4 for UK offices, 1.6 for retail and 0.7 for industrial. This means that for every 1% change in GDP, office rents have historically moved by around 2.4%. The relationship with inflation appears to be supportive of the view that the social and affordable rented sector can provide inflation hedging characteristics with a statistically significant beta of 1.2. So for every 1% change in CPI, social housing rents are expected to rise or fall by 1.2%, again reflecting that government policy linked to inflation. Next slide, please, Lizzie. Another key factor in establishing the quality of the income is to look at trends in occupancy. The chart on the left-hand side shows that tenants and social rented tenures have typically occupied their home for longer periods, with 80% of tenants staying for at least 3 years and 44% of tenants remaining in residence for over 10 years. This compares to just 10% of tenants staying in residence for longer than 10 years in the private rented sector. For investors, longer periods of occupation are of significant benefit as they reduce costs associated with the change in occupiers, such as reletting and minor refurbishment costs, and can thereby increase the net operating income over the life of an asset. Importantly, longer residencies also promote a sense of community and belonging, which brings additional benefits to all stakeholders. The sector has also benefited from strong rent collection levels. Bad debts have generally been consistently low, with current levels of around 1.5% of gross income. During the pandemic, private registered providers recorded rent collection of between 97 to 99% through Q1 to Q4 in 2020. By comparison, rent collection rates were significantly lower for the average commercial real estate asset, standing at between 60 to 70% for the same period. In summary, we think the sector benefits from high quality cash flow with lower volatility, lower correlation with other asset classes where revenues are more intrinsically linked to the business cycle. They have the ability to capture inflation-linked rental growth and benefit from stable occupancy with high rent collection levels. These should be attractive characteristics for both debt and equity investors. Slide 11. So having looked at some of the key cash flow characteristics, I'll now spend some time introducing some of the risks that investors should consider. This is not an exhaustive list, but some of the key risks that we feel investors should consider when investing in the sector. So firstly, reputation. Investors in the sector should be acutely aware that they are providing homes, and this includes homes to the most vulnerable members of our society. They will also be entering into contractual relationships with organisations specifically created for a social purpose. These facts rightly mean that investors need to take a strong position in terms of governance and independence in measuring the true impact that their investment is having on the community and the sector. We believe that a key aspect of minimising the risk to reputations is to ensure that the risk and therefore return is correctly apportioned between the various stakeholders, with the aim we think, of allowing private capital to achieve a fair risk-adjusted return. As mentioned previously, the rental growth of the sector is regulated by the government, and there is clearly a risk that a change in government policy affects future revenues and therefore impacts the ability of the sector to meet financial obligations, either rental or interest payments. The fact that the government has already mandated rent reductions in the recent past creates evidence that variations away from the inflation-linked rental growth is possible, and therefore is a risk that needs to be estimated and priced. Government policy in areas outside of rental changes may also have negative impacts on cash flows. For instance, the introduction and rollout of universal credit and the freezing of local housing allowances in cash terms from 2021 to 2022 clearly have implications for investment in the sector. The report has also adopted a top-down view of the sector and therefore assumed to a large degree that an investor holds sufficient assets to create a diversified portfolio. However, for an investor to achieve this, it is important to note key differences to establishing scale in commercial real estate portfolios. Firstly, the sector is far more granular in terms of the number of tenancies that investors require to manage, and this means the day-to-day management of assets is arguably more resource intensive. And secondly, within the regulated rented sector, there are additional complexities associated with ensuring that the provider has fully complied with all the necessary regulations for each tenure type. So that includes ensuring that the rent increases are in line with the policy. And as with other real estate assets, the social and affordable housing sector has to invest capital in order to maintain and improve the quality of existing stock. And as is the case with other regulations, there is a high probability that housing or ESG-related standards will be continually updated, and this can incur significant one-off lumpy capital expenditures for the owners of these assets. Investors will also need to consider what an appropriate capital structure is for the sector to ensure long-term alignment of interests and financial stability. It is likely that a balanced approach to investment structures is required, with a combination of both debt and equity required to finance the sector to create long-term sustainable housing provision. And lastly, the planning process for residential developments can be riskier than for commercial sectors, as there is likely to be more scrutiny and engagement with local stakeholders regarding the final design of a residential scheme, and possibly incurring longer delays through that process. Next slide, please. Now moving on to explore the investment universe of debt and equity. The debt funding accounts for the majority of capital used or raised by private rated providers to date. Looking at bond issuances of providers, this market is characterised by long-dated paper with a weighted average year to maturity at issuance of 28 years. In terms of security, 97% of the bonds are secured. Using secondary pricing for public bonds issued by private rated providers, we have constructed a weighted average annual yield and total return series. And the chart on the right shows the average yield to maturity for these bonds at the end of 2020 was estimated to be 1.9%. And as with other fixed income asset classes, the yield has fallen significantly from a weighted average yield pre-global financial crisis of around 5 to 5.5%. In terms of the spread to risk-free assets, maturity adjusted, has been fairly constant since 2015, averaging 140 basis points and ranging from between 110 to 160 basis points. Next slide, please. At the aggregate level, the housing sector displays characteristics of a high quality borrower with average gearing of around 50% loan to cost and strong interest coverage, even after taking account capitalised expenditure and the mandated 1% decline in rents in recent years. Issuers of social housing bonds have typically been rated single A by the major rating agencies, and to date there have been no defaults in the sector. Next slide, please. So on an annualized basis, bonds issued by private rated providers returned around 6.8% per annum in the period 2001 to 2020. This compares to 5.4% for nominal gilts and 7% for inflation-linked gilts. On a risk-adjusted basis, these bonds exhibited marginally higher volatility than the government bonds, and significantly lower volatility, as you would expect for both equities and typical institutional real estate equity portfolios. Using our proxy total return series, we can also see that the bonds appear to have low positive correlation with commercial property and the equity sector, with stronger positive relationships with the nominal and index-linked gilts. And this should provide diversification potential for multi-asset investors. Next slide, please. Now turning to the equity investment universe. Today, this is far more immature in terms of the public equity investment opportunities. That there are specialist REITs. Whilst these REITs target different parts of the social housing market, they share a similar cash flow characteristic in that rents are at least partly supported by central government finances and are subject to that inflation plus income growth income stream. Private equity investment into social and affordable housing remains in its infancy, but is growing, with a number of unlisted funds, and for-profit registered providers now having been launched. These funds cover both closed-end and open-ended structures and offer a range of risk profiles from full development through to income-producing assets that target different tenures and social needs. Both public and private equity have made use of both lease-based models as well as for-profit registered provider models. The for-profit provider business model could perhaps be classified as an owner-operator model, whereas a lease-based model, the operation is contracted to a registered provider. We expect to see continued innovation in the business models adopted by the sector as it matures and grows. So this is, we expect to see significant innovation going forward. Next slide, please. Continuing with private equity investment, a key component is clearly measuring the performance of investments, is looking at the mark-to-market value of the assets. Within the sector, there are two bases of valuation: existing use value for social housing and market value subject to tenancy. Broadly speaking, existing use valuations assumes the asset continues to be managed as a regulated tenure, whereas tenanted valuation assumes a conversion to private market rents. Over the short time period available, the sector exhibited higher growth and lower volatility than the commercial real estate sector. The sector should also offer diversification benefits for investors with a correlation to equities, fixed income, and commercial real estate close to zero. Over this period, there is also evidence to suggest that it is the changes in rental value rather than changes in discount rates that have been a dominant driver in changes in valuations. Next slide, please. So just to bring it all together, really. So in our report, we also set out our opinion on CAPM equilibrium approach to establishing forward-looking risk and return expectations for the sector for use in a typical mean variance optimization analysis. These forward-looking estimates uses our analysis of the fundamental risks that we explored through our research report that we've highlighted today. In line with our view, in line with our review of the sector, we think the risk characteristics should mean that the sector should be viewed as a lower risk diversifying asset class. For multi-asset portfolios in the chart on the left-hand side, we adopted a constrained model for allocations to both debt and equity investments limited to 5% of the total portfolio. Whereas for the real estate equity portfolio, we adopted an unconstrained model in terms of the weights that could be allocated. For both the multi-asset and real estate equity portfolios, adding the asset class to the portfolio improved the efficient frontier, so moving it up and to the left. And particularly for lower risk portfolios, but allocations to the sector were higher. In terms of optimal allocations for real estate equity portfolios, the allocations to private equity investment in the sector for lowest risk portfolios on an unconstrained basis was around 50%, highlighting the benefits of diversification and lower risk profile of the sector. And this then declined in a fairly linear form to around 5% for the higher risk portfolios. Final slide, please. So in summary, we believe that the sector exhibits high quality investment characteristics with stable operating performance, revenue growth that is predominantly inflation linked, low voids, high rent collection, and longer occupancy by the home owners or tenants. We also think that it offers investors diversification of potential across multi-asset portfolios with lower sensitivity to economic cycles and defensive income with high rent collection levels exhibited through the pandemic. The key risks are around granularity, operational complexity, as well as a higher degree of reputational and political risk than in other asset classes. Ultimately, we think that for the sector to deliver sustainable long-term returns for investors, which should be the aim should be for the creation of long-term partnerships between stakeholders with cultural alignment to create a sustainable delivery of quality accommodation that apportions the risk and return for the sector appropriately. And with that, I'd like to hand back to Jamie to introduce our panelists.
Thanks very much, Nick, for that amazingly efficient presentation of months and months of research. So now I'd like to introduce our discussion panel, starting by inviting them to turn on their video. They are Catherine Rainsford, Director of Stakeholder and Investment Management at Hyde Group, Adam Porter, who specializes in real assets research at Hymans Robertson, and John Raisin, who is an independent advisor to local government pension schemes and chair of Merseyside Pension Fund. So as a start, I'd like to get from each of you your perspectives and general observations on the research that Nick has just presented, and then maybe a few comments on social housing investment by pension funds. But let's just start with some general observation on what you've heard and from Nick and what you've read separately. Can I start with you, John?
Yeah, thanks. I think Nick gave a very clear and detailed explanation of social investment in investment in affordable housing. I think there was a cogent case for investment, but he's also very clear as to the risks, which I think is very important actually in overcoming any reticence there might be. I think for me, the most important section was actually on supply and demand, because I think the issue of supply and demand absolutely underscores why this is a very attractive long-term investment for pension funds, and particularly LGPS funds. I don't think there's any question that the issue of supply and demand has been with us for a long time, and Nick didn't say anything to suggest that the trends are going away. I'd be interested to hear Nick's comments on that, but I haven't heard anything either from any other source. So I think that's a sort of fundamental underscoring of the case, really.
Okay, great. Well, thank you, John, for that. Catherine, can we go to you?
Well, thanks, Jamie. And I'd actually kind of really echo what John said there, that looking at the fundamental supply-demand imbalance underscores not just the demand for this type of housing, but the necessity of sectors working together to deliver a step change and the sort of change that we need to see in numbers and output. And I think, Jamie, at the beginning of the session, you touched very briefly on the costs that are facing the housing association sector and indeed all large-scale residential landlords in relation to decarbonisation and the green agenda and building and fire safety. And in simple terms, the housing association sector will not continue to deliver at the levels that it has delivered over the next decade in view of those costs, unless it finds alternative ways to fund delivery. So at Hyde, we've had a kind of very explicit strategy for the last 3 years to work in partnership with well-aligned capital partners and specifically pension funds in order to increase delivery. And that for us was about additionality and about driving up our kind of annual development numbers from 1,000 to 2,500 homes. So material uplift that we know to be deliverable using our existing development and operational platforms. But over the last 24 months, what we've seen as a result of changes in legislation and those specific points on building and fire safety is a very, very real need to find alternative sources of funding as a sector to maintain as well as increasing delivery. So kind of coming from an association sector, the need is urgent. And then just on the point of alignment that I think was made so clearly by Nick's presentation, for us, looking to partners who think in the long term, who are ESG motivated, who are attracted by index-linked income streams that can be provided by affordable housing is a really, really natural alignment. And when those investors are local government pension funds who are able to invest in the delivery of new affordable housing in their areas, you've got such a natural, sensible circle there that it feels an obvious thing to do.
Thanks, Catherine. I think I have to say I agree with you that it seems an obvious thing to do, and there is a natural alignment. I guess when the Impact Investing Institute looks at what the LGPS are investing in, we don't find a lot of social housing. So I think one of the questions I want to come back to is why that might be. But first, let's go to Adam Porter.
Yep. Well, I think it's a very thorough bit of research, and for someone like me who's tasked with researching new asset classes and investment managers, we both look at the opportunities, but also the risks. And I think the report covers both in good depth. And one thing that I was pleased to see was the diversification benefits of investing in social and affordable housing. Generally, we've seen the UK pension fund market not make a great deal of investments in the wider UK residential property sector. So even in the private rented sector, as opposed to social and affordable housing, a trend I've seen is that is changing. I don't know how widespread it will be. It's likely to be driven by LGPS as more private defined benefit pension schemes de-risk. But I think we're going to see increased investment in both social and affordable housing, but also wider the private rented sector.
Okay, thanks, Adam. Let's probe a little bit more on this. So I think we've got a couple observations so far that LGPS are not investing a lot. I mean, we've looked at LGPS holdings and we find that there isn't that much activity. So and Adam, you've just now said that there's increasing interest. But what is the resistance in general within the LGPS sector? I mean, what are you all seeing? And any one of you could comment on that. So whoever would like to volunteer. What are the points of resistance? Let's talk those through.
Perhaps I can make a point from a sort of an investor's point of view. I think first of all we need to separate the issue, and many people know this already, but for those who don't, between local authorities and local authority pension funds. They are completely separate things. They are not the same. The pension fund is a completely separate account from any other local authority account, be it a housing revenue account or a general fund. And the guidance and regulation is very clear that LGPS pensions are not an executive function either, they're not a political function, so they are not related to the council's policies. So if an LGPS fund is going to invest, it has to do it on its own basis of its own risk and return factors. So I put that firstly, but that does not mean that there isn't a very strong case for investing. And it doesn't mean it isn't happening, because it is, and more will happen. I think there's a number of factors why it hasn't happened as quickly as perhaps some people might have hoped. I think the first one is that social and affordable housing has come later to the LGPS than other real assets, such as renewable infrastructure, such as even private rented sector housing. I think one factor is that unless a fund is internally managed, and only the very big funds are, most funds rely on asset managers, and the asset managers have been quicker to bring to the LGPS things such as renewable infrastructure, because there's a lot available, or has been in the past, or private rented sector housing. And when I talk about that, that's for perhaps people who are on moderate incomes. We're not talking about housing for high income people on moderate incomes, perhaps qualified public sector workers, etc. That has been, I think, something which the asset managers have been able to do more easily. And finally, and crucially, you don't invest in something unless it's in a strategic asset allocation. And unless the case is made for the asset class, it won't be in there. Now, again, infrastructure has come in, but in most cases, infrastructure has been thought of in terms of either energy or transport. Now, some housing is infrastructure, and some funds have used that to invest, particularly in private rental sector housing. So I think that's the case. And I mean, this asset manager point is, I think, important. Organisations, you take an example, Invesco, for example, with their PRS, or CBRE, two big asset managers who've got a lot of influence with the LGPS. If they come forward with products, they're more likely to be taken up. And I think that's been one of the issues, but it is changing, and we are now, more interacting with the sector more widely. So I think that's the explanation, but it is coming, and I'm absolutely convinced it is.
Okay, Adam, you live in the intersection of pension funds and those asset managers that we've just been talking about. So what's your perspective on this? Where's the?
Well, I think first, I'd agree with everything John said there, but when you're assessing investment opportunities for a pension scheme and making recommendations, asset classes have to stack up from a risk and return perspective, and there's a lot of competing asset classes, and we try and find what are the best opportunities for our clients. And I think in the past, the residential properties of the wider PRS and social and affordable housing sector hasn't offered compelling enough returns relative to some other asset classes. So, in the likes of real assets, there's generally been a bit of a focus on infrastructure. Most pension schemes have property in their strategic asset allocations, but that's largely to commercial property, often through funds. If you look at what the commercial property managers have been investing in, they've rarely ventured into residential property. Really, it's been sort of purpose-built student accommodation, and that's been a function of the risk and returns there. So, that I think that partly explains why. So, unless you're coming at it from a purely impact perspective, it has to stack up. But then there's also a question about there just wasn't a great deal of options for you to invest in. I think that's what we've really seen change over the last couple of years, especially. There's just the variety of options available. So multi-tenure, single tenure types in social affordable, and even the private rented sector. That will help encourage investment, but asset classes have to stand up on their own 2 feet and the merits have to be made. And certainly when we're discussing social and affordable housing with with clients, there's questions around fire safety and the risks, all of the risks that were highlighted in Nick's presentation. So there's an educational element required as well to get investors comfortable.
Yeah, I think we should be very clear. I mean, we've said it, and John has said it, and you've just said it, Adam, that these need to be investments. These are investments. These are not concessionary investments. And you notice that the report that we've just done is really almost entirely on the basis of social and affordable housing as an investment. It does not make an argument for doing so on the basis of social considerations. And so, but what I would say is that what I've seen in the report is that there is a interesting case on the risk return, the correlation, the sources of revenue for the social housing sector that, to me, suggests an investment case independently of whatever social motivations you might have. Catherine, from your perspective, when you talk to, I don't know what kind of capital you look for from the market, whether it's just debt or it's a mix of debt and equity, but what's your perspective on what are you hearing from asset owners, in particular pension funds, but not exclusively?
So we've had a very intentional focus on forming equity partnerships in recent years, and that has been, as I said, motivated by the desire to deliver more homes than we can deliver using a debt and grant model, so the existing public subsidy and debt model, but also by a recognition that there are, in our view, very significant benefits that we as an association can gain by working with the right sort of robust institutional partner. And by that I mean aspects of sustainability policy, for example, that are very important to pension fund clients, which will help to hone our own agenda and strategy. The added rigor that as an association we are subject to when we work in partnership with an institutional client, developing homes and operating them on their behalf. And those things lend a kind of new lens to our business and an ability to drive, in some ways, efficiencies and process improvement, but also, to take a kind of really, really basic point, but the way in which we're looking at data when managing on behalf of a relatively small scale portfolio on behalf of an institutional client just enables us to operate at a more granular level than we do day to day in operating 50,000 homes of our own. And that for us offers a lot of opportunity. So we perceive the benefit in partnering with institutional equity to be about capital, of course, and the ability to deliver a significant uplift in the number of homes that we can build, but also to do with the benefits that we get from working with those sorts of partners. And just to give one example, we formed a strategic partnership in March with M&G, which is about the delivery of shared ownership homes in a new shared ownership portfolio of what will be 2,000 homes in the coming years. And as part of that exercise, we've worked incredibly closely to understand their agenda and their kind of specific wants, and to work out how we can marry those together. And so in taking forward our first ESG report, we were quite influenced by what we felt to be the direction of travel that we would take in working in partnership with M&G. So I think we see the synergies as being beyond the capital, the positive benefits for the association sector as being greater than the capital.
Let me ask a specific question on debt issuance. So Catherine, I imagine you issue your debt at about 2%.
So our most recent bond issue was at 1.75%.
Okay.
But our average cost of debt will be somewhere above that, taking account of everything.
Okay, so that's a spread over gilts of 80 basis points or something like that. I'm just guessing, but so you've got an investment that is low yielding, thought to be low risk, and what Nick has said in the report is that there's an appropriate risk return, but it's still only 2% debt. So my question to maybe John or to Adam is, can pension funds buy instruments that yield more than gilts, but still that, in the 2% space?
Personally, I wouldn't want to buy that. At the end of the day, there's a 149 accrual rate in the LGPS. It's an open defined benefit scheme. And if we fail to make investment returns, this is a really crucial point. There's only one place that the money can come from, and that is from the employers. Because remember, our accrual rate is fixed by government, and so are employee contributions. And if the employers have to bear more, that's primarily councils. And what is most council money spent on? Well, I used to be a social services accountant. I can tell you what it's spent on. It's spent on the most vulnerable people in society. So we have to make the investment return. But what Nick has made a very strong case for is an investment case for equity. And there is a very strong equity investment case for social and affordable housing, as Nick has made. I think it also meets a number of other tests, which is the income test in the LGPS. We need more income because we're becoming a bit less or a bit more mature, and we're getting less from past service contributions because we're becoming better funded. And there's also the inflation risk. Our benefits are linked to CPI, as Nick has explained. There's a CPI linkage, not for everything, but for quite a lot. So there's some very strong investment cases for equity. So I wouldn't myself think there is for debt, but for equity, certainly.
Adam, do you have a different view on debt? I'm wondering if you're a pension fund that's investing in gilts, then this is going to give you a higher yield in gilts, and you have to make your own system as to whether the risk, the increment in return is matched by the increment in risk. But what's your view on the yields, the low yield, and what would you think? What would a pension fund think that was already investing in gilts?
I don't think they would compare social housing debt to gilts. Like, frankly, it's lower yielding, but actually then, how low risk is it? And you got to look at the quality of the registered provider sector, and looking at the regulator's website. I think there's lots of questions around their oversight of registered providers. So they issue a number of judgments. They look at the governance and financial viability of housing associations, and when I read their reports and judgment, that doesn't necessarily read to me as a low risk sector. So I totally agree with John. I think there's a far stronger equity case for investment in social and affordable housing than on the debt side. And if it's going to be debt, the yields would have to be more favorable than in other alternative asset classes. They wouldn't. I just don't see people viewing it relative to gilts.
Okay, that's good to hear. I think what's interesting about this is that it's actually the sector is underserved in equity. It's never had trouble getting debt investment from a variety of sources, including insurance companies and others who maybe don't need to get the kind of yields that pension funds are looking for. but the sector is really short of equity. So I think equity is really one of the interesting spaces there. Now, Nick, you mentioned that one of the risks is that you need to make there's a good apportionment of risk among stakeholders. Could you elaborate on that? And does it not happen? I mean, talk to us a little bit about that risk. What does that look like?
Yeah, so our comments really around ensuring there's alignment of interest, really, and that ensuring that stakeholders, whether they're not-for-profit organisations that are delivering a housing need for local communities, may be increasing or may have a sceptical view of private capital coming into the sector, and taking a rental payment or a revenue or interest payment out of the sector for investment purposes. And so really my point there is that capital coming into the sector needs to be aware of these factors, and that they should be looking at pricing these investments based on equilibrium, risk return, fundamental characteristics of the sector, and be a long-term sustainable partner for the operators in the sector, rather than seeing it as a short-term investment to fill a gap. So this is a long-term strategic investment, or should be viewed as such, that's providing a social infrastructure, social need for society.
Okay, all right. Thanks for that, Nick. Catherine, I wanted to ask you that I'm drawing on the questions from the audience now. There's a question to you, which is, what were the main issues? I mean, there's obviously interest in the arrangement that Hyatt has done with M&G. So what were the main issues you needed to overcome in securing investment agreement with M&G for a 2,000 home portfolio?
It's a really good question. I guess one of the things that happened at the outset and kind of before we entered into negotiation with M&G was that we had a very clear set of guiding principles laid down by our board. And in a sense, for the team that was ultimately kind of recommending the transaction and transacting, that gave some very, very clear guide rails in relation to the sort of equity that we wanted to partner with and the terms on which we wanted to partner. And it was absolutely about ensuring that we had a real alignment of values, and importantly, that our future partner was willing to sign up to a principle about what we've called ownership blindness, but that Hyde would manage a portfolio of homes that we own, of homes that are owned by M&G, and of homes that are existing homes owned by local authorities, 7,000 of which we manage in the London boroughs of Brent and Islington. And in order for us to have an effective strategy of not owning our entire portfolio and offering the same high quality service to residents, that principle of ownership blindness was incredibly important. So laying down some of those kind of guide rails at the outset, I think was very effective and very helpful for us. We negotiated and agreed terms and indeed exchanged and closed the deal during lockdown. So actually there were some challenges there, but in some ways the ability to do very, very regular Teams calls with M&G and with their legal team gave us an opportunity to spend the time that was necessary for two quite different organisations to get to know each other, and for two different sectors to understand each other better. And I think this really echoes what Nick's been saying and what John's been saying too, that there is a need for capital coming into the affordable housing space to understand the playing field and some of the kind of slightly esoteric aspects of the sector. And that does take some time. So I think had we not had in M&G a kind of prospective client who was very, very keen to do the work, it would have been much more difficult. But I think their focus and their willingness to really engage with the detail of the affordable housing market was incredibly important. And I think one of the things that would ordinarily be a challenge in transacting this sort of arrangement is getting a board comfortable and getting kind of internal stakeholders comfortable with doing something that the organisation hasn't done before. And actually in this respect, we were incredibly fortunate to have a non-exec group who really sat with us along the way, took a lot of time to understand the nature and terms of the transaction, and were able to guide the team through the process. So I think there are many challenges. Getting to know you is a big one of them, but I think we were very pleased with the result.
That's a great story, Catherine. Somebody should write that up. It might have to be the Impact Investing Institute. So we'll be back in touch, because there is a very It's a very interesting story, and it's a great question. I should have mentioned that the question was from Philip Jackson. Here's one for Adam and John to come back to the impact dimension to this. So how seriously is the LGPS community factoring in social impact alongside traditional financial risk return considerations? And that's from Chirag Sachdev. John and Adam, do you want to take a look at that?
I'll take a first go at this. I think it's very important to them, and for the size of LGPS can vary. So many look to the likes of Hyman Robertson to provide effective oversight and views on social impact, and that's something that we are very strong on. And my own perspective. So I am a shared owner, and understand the risks and some of the practicalities that living in social housing can bring. So I've seen firsthand some of the challenges. Now we can then take that forward and scrutinize the investment managers who ultimately will invest in social and affordable housing to actually get a real sense of, are you looking to raise standards, and ultimately benefit the underlying tenants in this accommodation. I think there perhaps is some skepticism, about the role of private capital. Are they just in it to make a profit? I don't think so. And the responsible investment requirements have increased so much over recent years. We're getting asked to do a lot more reporting on this. It's only going one way as well, and that's something that it will evolve over time, just as the investment market finds its feet. But I think it's something that's very highly up the agenda, and something when we're assessing investment managers, we're going to be scrutinizing them very closely.
John, a comment there? You've already made the distinction quite clear between it needs to pass muster on the investment side, but what about the additional factors?
Well, I mean, ESG factors, including social factors, are risk factors and opportunity factors, that they all link into investment. They're not separate from investment, that they are part of the investment equation. And there's no doubt in terms of social issues that if we have not just a positive social impact for the tenants, but organisations and partners who are providing a positive social impact, for example, for their employees, and I think that's becoming even more clear in the present situation we're living in. If we are interacting with organisations who have responsible employment policies, etc., that helps make sure the investment is more likely to succeed. So yes, it is important because it's all part of the investment equation. Yeah.
Okay. Thanks for that. I have a question for Ben Denton, who's asking: is the key challenge about getting the fact that there are relatively few routes to market for pension fund investors to get to equity? Is that an issue? I mean, Nick, do you want to comment on that? Is the problem that pension fund investors can't find enough routes to equity?
Yeah, it's certainly a significant hurdle to overcome, and it's not just the availability of products, but it's also perhaps capacity and the ability to increase development with an existing registered provider. They might not have the existing capacity there to increase, day one. So it's I think it's going to be a slow, fairly slow journey in terms of getting the right pieces in place with the right governance behind it to get the sector moving. But I think clearly asset managers like L&G, M&G, CBRE, Schroders, etc., sort of moving into this space and creating those products and starting to actively engage with stakeholders and start to create scale. Hopefully that will start the process, and quicken the the route to market for pension capital. And it's not just local authority pension capital either. It's corporate schemes as well that are maturing in the UK. So it's not just an investment case for local authority pension schemes. It's across the board in terms of this sector fitting into those pension scheme assets.
Let me ask you a follow-on question from Emily Bush, who's asking, she says that you've mentioned innovation and business models being adopted in the social and affordable housing sector. Could you elaborate on that?
Yeah, so through engaging with stakeholders through the process, we're talking to ranging from very small organisations right through to sort of large-scale organisations, and they were constantly thinking about what's an appropriate way to establish relationships. Is it through JVs? Is it a fund that's managed, open-ended, closed-ended? But also how you manage that sort of owner-operator type relationship between them. And I think there seems to be a lot of thought going into how to establish a model that does create those long-term synergies between the stakeholders. And to date, we've seen sort of lease-based models, sort of JVs, etc. But I just think there's a significant scope here for the ESG credentials, impact investment, to really influence the governance and structure of the relationship in the sector. And so I think given the stage we're at in terms of actually entering the sector, the more discussions that private capital and existing operators in the sector have, I think we'll see some really interesting models that are adopted to actually fulfil this need. And there's no one-stop solution, I don't think, for this. So it's going to be I don't have any sort of specific examples per se, but I think we should see some really good and exciting innovation in terms of how it's structured.
Let me give my last question to Catherine. Catherine, Sophie Simmons is asking, and we have to be quick about this, but does the right partnership, the right cultural fit for a registered provider mean that UK LGPS investors are preferable to overseas investors? What's your view on that?
I suppose for me, the right partnership is equitable risk sharing in the long term and an alignment of interests. And actually, I wouldn't want to. We love the idea of working with local government pension schemes, and we love the idea of investing in housing in kind of areas over which we've kind of both got jurisdiction. But to my mind, it isn't necessarily the case that one investor is preferable to another. It is simply the case that you've got to get the structure right. And so any model that puts risk in the wrong place in the long term and prejudices the association in a way that is unhelpful and potentially puts charitable capital at risk is not the right arrangement. And so focusing on structure and getting the commercials right in the long term for me is absolutely the most important thing here.
What a great observation to close on. Thank you very much for that. So here we are, 11 o'clock. So I'm going to have to bring this discussion to a close. So as predicted, we didn't get to all of the questions. But it does tell me that there's an appetite for continuing this conversation on the investability of the social and affordable housing sector. And maybe it's the Impact Investing Institute and other organizations who are in this call who can sponsor that ongoing debate. So our hope at the Institute is that this discussion will ultimately direct more capital, both debt and equity, to addressing one of the UK's largest and most urgent issues. And the Impact Investing Institute, along with many others, would like to see the debate shift beyond the basic investability of the sector to one that looks more actively at how the capital going into the sector can be more explicitly purposeful and intentional. So in order to create positive social and environmental impact, it's then measured, managed, and reported. So I think we have more to do. I'd like to thank Nick Cawley for presenting the research today, as well as our panelists, Catherine Rainsford, Adam Porter, John Raisin, and thanks to you, our audience today, in joining us in this discussion. I hope you find the research useful in your work and your ongoing thinking about the housing sector. So have a great day, everybody. Goodbye.